Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
That's right. You're listening to the U.S. Market Update with Emaad, Akhtar. All three major indexes closed yet again at record highs Tuesday as investors moved past concerns about the state of the U.S. economy. The S&P 500 index settled up 0.27% to close at 6,512, while the Nasdaq Composite gained 0.37% to end the day at 21,879, with the latter hitting a new all-time intraday high as well. The blue chip Dow finished up 0.43% to close at 45,711, thanks to a surge in United Health shares. Now, investor worries that the economy may not be holding up as well as previously thought were exacerbated after the Bureau of Labor Statistics updated its jobs figures for the 12 months through March, lowering the total payroll gains during that period by a whopping 911,000. Not only were the revisions on the high end of what Wall Street anticipated, but they were also the largest on record going back to 2002. Let's dissect that news and more with Todd Rabold. He joins me on the line now. He's an investment management partner at Callan Family Office. Todd, welcome back to the show. How are you doing?
I'm doing well. Good morning, Emaad. Thanks for having me back.
Yeah, thanks for coming on. It's rather timely given these revisions to the employment data. Staggeringly, the total payroll gains during that period were reduced by a whopping 911,000. That's the 12 months preceding March 2025. That being said, markets still rallied. What's going on here?
Yeah, so I think the markets are really focused on the jobs report that came out on Friday, which was materially weaker than expected. So 22,000 jobs were created versus the 75,000 that were expected. July was also revised downward to losing 13,000 jobs, the first negative month since December 2020. But I think the announcement today that you highlighted with the reduction of 911,000 jobs was also concerning, but it is looking back in the rearview mirror. And the Bureau of Labor Statistics compiles this data, and the recent significant revisions have led the Trump administration to make some personal changes there to improve the quality of the data. Nonetheless, it was disappointing data that likely is being influenced more recently by tariff uncertainty and tougher immigration rules that have limited the labor pool. But to your point, the markets were up today, and I think what's encouraging is tech spending remains quite strong. Lots of good data there. A couple of great earnings releases also after the close. Consumer spending remains strong, as does government spending. So we expect the U.S. economy to grow in both the third and the fourth quarters of 2025, although it might be a little bit weaker than some folks expect. And for perspective, the Federal Reserve Bank of Atlanta is forecasting 3% growth in the third quarter, which is quite strong.
Yeah, as you rightly pointed out, Todd, the tech firms are leading the rise in the markets. And I want to turn your attention to a CNBC article I read online, which suggests, and this is an implication that the author highlighted is purely speculative, that there might be a silver lining to the job losses in that they indicate that AI is working as intended for companies, not job seekers, that is.
Yeah, so I think we're in the early innings of AI. There's significant investment in tailwinds. Hundreds of billions of dollars are being spent on the infrastructure, and we think that's going to continue for a number of years. Clearly, there's a bunch of companies like Amazon, Apple, Google, NVIDIA, and others that are capturing a lot of that investment spending and revenues. But we do think over time that trade's going to broaden out, and many more companies will participate and benefit from those technologies in the coming years.
Yeah, I think that was also highlighted yesterday. CoreWeave shares jumped on news that they've launched a venture fund to invest in AI startups. They're, of course, backed by NVIDIA, perhaps the latest example of a tech giant turning to the growing world of startups to gain more exposure to early-stage AI innovation. Is that a harbinger of things to come, you think?
Yeah, so at Callan Family Office, we invest in some private capital funds that are particularly focused on investing in early-stage AI companies. NVIDIA, obviously, is a great example of that, and CoreWeave, too, and many others. So I think there's ample opportunities for companies to create new revenue sources utilizing AI, and I think it's perhaps the fastest growing area of the technology space that we see today.
All right, great. Let's move along to the next FOMC meeting. It's just about a week away. And one indication of where the Fed might move in terms of rates is the labor market data, which has been underwhelming. Another indicator is inflation. We have two key inflation prints out this week. In fact, PPI comes out, I believe, today, and CPI comes out tomorrow. What are your thoughts on that front? I think Thursday's CPI number, the consensus is now expecting inflation to go up from 2.7 to 2.9%, and that might muddy the picture.
So we do have some inflation data coming out this week, and Chairman Powell of the Federal Reserve continues to cite concerns that tariffs will continue to increase inflationary pressures. Inflation certainly is moderated over the past 2 years, but it's higher than the Fed's target of 2%. With the weakening job market, we think that data will be sufficient for the Federal Reserve to begin to cut the Fed funds rate over the coming 3 meetings. So unless we get a really surprisingly strong CPI number on Thursday, we still think that the Fed's going to cut rates in the next 3 meetings, probably by 25 basis points or 0.25% each meeting, ultimately reducing the Fed funds rate by 75 basis points this year. And, of course, as you know, that would be probably pretty favorable for both the stock and the bond markets, both in the short term and the long term.
Yeah, I know the Fed's funds futures and yourself largely pricing in a 0.25-point interest rate cut at the next meeting, but some surmise there's a small chance of a larger half-point decrease. Your thoughts on that matter?
Yeah, I think it's a low probability event. I think the futures are suggesting there's a 10% chance of that. And if we were to get a very low inflation print tomorrow and Thursday, then perhaps that becomes a higher probability. But nonetheless, I think the markets are expecting a minimum of 25 basis points.
All right. So, Todd, what's the investor playbook right now? Are you looking at stocks, bonds, precious metals, holding cash? What's going for you?
Yeah, so, we continue to have a positive view on the U.S. economy and, frankly, the global economy. And, valuations are a little bit on the high side. But we do believe that owning U.S. stocks, international stocks, continues to make sense. In the U.S., beyond the technology trade, which we are very enthusiastic about, we think that small cap companies have been largely ignored over the past multiple years. And they had quite strong earnings growth this past quarter, up double digits. Valuations are very reasonable. We've seen over the past 4 or 5 weeks, small caps outperform large caps. So we think that's an area of the market that people should be thinking about if they don't already have exposure.
All right, fair enough. Small caps might provide a window of opportunity for investors in the current market environment. That's according to Todd Rabold. He is an investment management partner at Callan Family Office. Todd, as always, great chatting with you.
Thank you. Have a good evening.
Thank you, Todd. Have a good one. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.